This is a daily market monitoring system built around dealer hedging structure for retail investors and smaller accounts. It does not predict guaranteed moves or connect to a broker to place trades. Instead, it helps you find tickers worth watching, then read key levels, volatility risk, and options structure. Use it in this daily sequence. Start with a full market scan. Then review the 3 dealer evidence screens. Next, set price alerts. Put ideas that need confirmation into a paper trading watch list. Finally, use the options calculator to check strategy risk. Now let's start with the full market scanner. The system first screens real snapshots of U.S. stocks and ETFs for liquid candidates. Then it checks the top-ranked names across options chains, volume, open interest, and Greeks, as well as volatility and gamma structure. You can choose the full market, core liquid names, growth tech, or a high volatility watch list. You can also filter for bullish or bearish evidence, premium selling research, squeeze formation, and reversal risk. The common symbol selector lets you quickly view index ETFs, mega-cap tech stocks, semiconductors, and other popular tickers. The 4-quadrant map in the center helps you quickly read direction and volatility pricing. The horizontal axis shows directional evidence. Farther left means more bearish. Farther right means more bullish. The vertical axis shows the IV premium over historical volatility, or HV. Higher means options are relatively expensive. Lower means options are relatively cheaper. The larger the dot, the higher the options market impact score for that ticker. Hover over a dot to see the ticker symbol, data status, current price, percentage change, direction score, IV versus HV, options impact, call wall, put wall, gamma flip, and zero-day options share, squeeze status, core evidence, and the current suggestion. On the right, don't look only at the direction score. Step 1 is to check the data status. Live means the current evidence is fairly complete. Partial or delayed means it needs more verification. Step 2 is to check the premium selling gate and squeeze proxy to see whether the setup is researchable, requires caution, or should rule out selling uncovered options. Step 3 is to check the 30-day expected move, short interest, days to cover, and earnings risk. Finally, review why it made the list and which risk gates are active. If the screen flags negative gamma, too much zero-day exposure, wide spreads, or weak data coverage, do not size up aggressively and do not sell naked options. After confirming the setup, open the dealer evidence screens or go directly to strategy payoff analysis. The dealer panel now includes 3 evidence screens: GEX structure, dealer flow, and volatility and heat maps. Each screen can open in its own window, which is useful for a multi-monitor setup. After multi-window sync is enabled, changing the symbol in the main window, timeframe, or expiration will update the other windows as well. GEX structure mainly tells us whether the current market is more likely to stabilize or amplify volatility, and which prices may become important boundaries. Above the zero line is positive gamma. That area usually dampens volatility and can create pinning. Below the zero line is negative gamma. Hedging activity there may amplify moves in the direction of price. Remember, positive gamma does not mean price must go up. Negative gamma does not mean price must go down. Gamma flip is the boundary where the state may change. Call wall and put wall provide reference areas for overhead resistance and downside support. Max gamma marks the strike with the highest gamma concentration. The time chart next to it projects the current options cross-section onto the real price path as a structural reference. It helps us observe how GEX may change under different price conditions. It should not be treated as exchange-published historical GEX. The dealer flow screen is used to observe hedging pressure that options trading may create. Net delta pressure reflects the combined directional pressure. Call pressure and put pressure help show which side is contributing. Zero-day options pressure is used to watch whether intraday risk is rising. The current point on the chart comes from the latest options cross-section. The earlier shape combines real underlying price with volume to form a projection. It helps identify acceleration, flattening, or reversal patterns. It is not historical net options flow. The contract detail table below lists time, contract, expiration, and strike, volume, open interest, and estimated notional premium, plus delta, gamma, and vega activity. When unusual call or put activity appears, the related row flashes red to remind us to review it further. When trade-level aggressor direction is unavailable, these values are proxies for activity and hedging pressure. They should not be described as confirmed dealer net buying or net selling, or as true historical capital flow. The next section is volatility and heat maps. This screen first draws the IV expected move directly on the price chart. Here you can see the current price, plus and minus half a standard deviation, plus and minus 1 standard deviation, and other key price lines. When you select a different expiration, the system recalculates the move based on remaining time, and that expiration's at the money IV. So a 1-day, 2-day, and longer dated range will not be the same. The price chart supports hover details, mouse wheel zoom, click and drag panning, and vertical scaling from the right price axis. For short-term monitoring, always confirm the time frame and expiration first. The gamma heat map shows whether prices near the market are mainly in positive gamma, negative gamma, or near the zero line, with the price path overlaid on the heat zone. The delta pressure heat map shows potential buying pressure, selling pressure, and neutral zones across price and time. Charm pressure helps observe hedging pressure created by the passage of time, especially near the close and around pinning zones. Further down, IV versus HV compares options pricing with realized movement. Skew compares call and put volatility across strikes. The term structure compares IV across expirations. If front-month volatility is much higher than back-month volatility, and an event such as earnings is coming up, watch for an IV drop after the event. After you find a price level worth waiting for, you can set an alert directly. Click the bell next to a key expected move level. Choose an upside breakout, a downside break, or a simple price touch. After setup is complete, open the Price Alert Center in the lower right corner. You can view the ticker, target price and expiration, current price, and most recent trigger time. You can also pause or delete rules. The first time you use sound, click Enable Sound first, then test the sound and adjust the volume. When price reaches the condition, the page shows an alert and plays a notification sound. Alerts are stored in the current browser and checked about every 30 seconds. The page needs to stay open. If you close it, background alerts currently stop. They also do not sync automatically to other devices. If an idea is worth further validation, you can move it into personal paper trading. After signing in, confirm the imported ticker, choose an observation plan on the right, then enter the expiration, quantity, risk line, and target price. Save it as a paper observation draft. The draft appears on the orders page. The market snapshot in the center continues to show current price, gamma flip, call wall, put wall, and expected move, ATMIV, historical volatility, and risk status. The best current use is to record the observation conditions at that moment. Afterward, manually compare whether price reaches the target or risk line and whether market structure changes as expected. The current manual observation draft does not automatically import complete option legs. It should not be treated as a completed paper entry, automatic P&L, or closing workflow. This does not connect to a broker, and it will not send real orders. Finally, use the options calculator to check the strategy. First, choose the symbol and expiration, and review options quote coverage, Greeks coverage, and data status. Then choose a strategy template with calculable risk. Check each leg, buy or sell, call or put, and quantity, strike and premium, implied volatility, quote, source, bid, and ask. Then set the valuation date, IV change, and fees. The right side calculates net premium, maximum profit, maximum loss and reward to risk ratio, break-even points, and portfolio delta, gamma, theta, and vega. When reviewing a strategy, look at maximum loss and break even first, then consider possible return. The payoff chart supports hover inspection, mouse wheel zoom, click and drag panning, and double-click reset. The calculator is for research and scenario analysis. It does not connect to a broker. The model may miss early exercise, volatility surface changes, or real slippage. Scan the market first each day. Then use GEX, dealer flow, and volatility heat maps for cross-checking. After finding key levels, set alerts. Put ideas into a paper trading watch list, then use the options calculator to check risk. Do not rely on a single indicator.